Hello guys, welcome to video lecture. This is an ISR initiative from Sivananda Sharma Memorial RV College. Ssmrv College is one of the premier institutes run by the prestigious RV group of institutions, and it has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Pallavi of Department BBA, is posting a video on the subject financial management and the topic is dividend policy. Please watch the video till the end and like, share with your peer groups and subscribe to our YouTube channel. Thank you. So now let's begin. Firstly, let's understand what is dividend and how does the company pay the dividend. You all know that the company earns profit and that's the major objective of any company, right? So out of the profit earned, the company has to take care of all the indirect expenses, and then they have to pay for the interest to debenture holders, and then they have to pay the taxes, and now comes the dividend to be paid to the preference shareholders. So after paying to the preference shareholders, the remaining amount is called earnings available to equity shareholders, which will be divided among the equity shareholders. So all these you have studied in the previous chapter. Now whatever a shareholder, when he invests in a company share, obviously he expects some return, and that return is nothing but the dividend which is given in the form of a return to a shareholder who has invested in a company. So there are different dividend policies which a company can adopt. So we will be discussing about that in brief in the further slides. So now let's discuss about dividend. But I have already explained in the previous slide, but still I would like to read out the definition. According to Institute of Chartered Accountants of India, dividend is a distribution to shareholders out of profits or reserves available for this purpose. So dividend may be defined as a return that a shareholder gets from the company out of the profits available. So now the definition of dividend policy. The dividend policy determines the ultimate distribution of the firm's earnings between retention, that which is nothing but reinvestment, and cash dividend payments of shareholders. Most of the companies, they pay dividends to all the shareholders, but then again the companies want to retain some of the profits for reinvesting in the business. So the dividend policy will be decide like how much dividend or cash payment should be paid to the shareholders and how much the company has to retain for the expansion or reinvestment. Okay, that is called dividend policy. So now let's understand the different types of dividends which a company pays to the shareholders. So the first one is cash dividend. So as the name itself tells you, it is nothing but the cash distributed to shareholders out of the earnings of the company. This is the usual practice in Indian corporate sector. And the second one is stock dividend. Stock dividend is nothing but the company's own shares is issued to the existing shareholders instead of cash dividend. Payment of stock dividend is popularly termed as issue of bonus shares in India. Apart from whatever the shareholders have invested in the company, the extra shares will be credited to the shareholders account as bonus shares, which can also be considered as a dividend which is paid to the shareholders. And the third one is property dividend. Under this method, dividends are paid in the form of assets instead of cash. Okay, so the next one is scrip dividend. Scrip is nothing but a document or an instrument. Okay, under this method, what happens, the company will pay the dividend in the form of transparent promissory notes. When there is less liquidity in the company, they pay dividends through scrip dividends. Okay. And the last one is liquidating dividend. When the board of directors wishes to repay the capital originally issued by or invested by the shareholders, then that type of dividend is called liquidating dividend. Usually this type of dividend is paid during the winding up of the company. So the next topic is types of dividend policy. And that first one is the regular dividend policy. Payment of dividend at the usual rates is termed as regular dividend policy. The investors, such as the middle class families, retired persons, and institutional investors, usually prefer this type of dividend policy because they get the regular returns. And the second one is irregular dividend policy. When a company does not have a long standing or a stable earnings, what it will do is it cannot commit itself to pay the dividends regularly, right? That's why they follow irregular dividend policy, like because they have the lack of liquid funds and the future earnings is very uncertain. In those cases, the companies follow irregular dividend policy. They pay to the shareholders, but it will not be on a regular basis. So the next policy is stable dividend policy. Stability means consistency. You all know that, right? So this is a policy where the company pays certain amount of dividend every year consistently, whether more or less some amount they are committed to pay to the shareholders. Okay. So in this case, the investors who are depending on the dividend as a source of income, it is very useful for them because they get that some stable amount or consistent amount as dividend, so that they can take it as a source of income every year. And the last policy is no dividend policy. The company may follow a policy of paying no dividend at all. Okay, because they want to invest the profits earned for the future growth and expansion of the company. But they have to convince the shareholders regarding this. They will not get any benefit apart from their capital appreciation, but future shareholders will be benefited in the way of more profits. So these are the different types of dividend policy. Any doubts, please let me know. So now let's understand the importance of stable dividend policy. So first point under that is it brings confidence among shareholders. You know why? Because they get a stable amount or a consistent amount every year from the company, right, for their investment. And the second one is investors' desire for current amount. That is the current amount. Many investors, especially like retired people, they want some income for to meet their expenses, day to day expenses, right? So they get some regular amount, they are happy. It also benefits the institutional investors. Guys, you know what? Investments are made not only by the individuals but also by some institutions, and even institutions prefer regular dividend payments. And the next point is stability in market price of shares. When a company adopts stable dividend policy, the advantage of this is it can maintain a stability in the market price of its shares. Don't you think it's a very good advantage? Yes. And the next point is raising additional finance. A stable dividend policy is also very advantageous to company in raising external finance. External finance is very much required for a company. Yes or no? And the next point is spreading of ownership of outstanding share. Guys, stable dividend policy may also help in spreading the ownership of shares more widely among small investors. Okay, and that's really a good advantage when a company adopts this dividend policy. And the next point is it reduces the chance of loss of control. How does it reduce the loss of control is spreading of ownership for outstanding shares among the large number of small investors. The chances of loss of control by the present management over the company may be higher, but in case of stable dividend policy it can always be reduced. Okay. And the last point is market for debentures and preference shares. A stable dividend policy also helps the company in marketing of outstanding shares and debentures, and that's also a very good advantage for the company as well as for the shareholders, right? So these are the importance and or significance of stable dividend policy, which is quite important for your exam. So the next topic is factors influencing dividend policy. Guys, this topic is important for your exam. The first point under this is type of industry. See, public utility companies, it's not so difficult for them to pay fixed dividends for the shareholders. right? So they adopt fixed dividend. But whereas industrial concerns or private companies, it's quite difficult for them, to adopt to a fixed dividend policy. So it is based on the type of industry whether to decide on the dividend policy. So the second point is age of corporation. See, if my company is newly established, very recently established, can I commit to my shareholders on a fixed dividend? It's very difficult for me, right? So age of corporation is one of the very important factors which influence on dividend policy, which kind of policy to adopt. And the next point is extent of share distribution. See, if a company is closely held, it is easy for the company to get the consent of the shareholders for the suspension of dividends or conservative dividend policy. But what if the company is very huge and it has a large number of shareholders, and if they are widely scattered, do you think it's easy for them to have a consent of from all the shareholders for the share distribution? So again, the extent of share distribution also is a very important factor which influence the dividend policy. And the next one is need for additional capital. As I told you, if a company is newly established, obviously the company thinks of growth and expansion, right? In those cases, they always think of a good dividend policy because they would like to invest their profits, reinvest their profits for the growth and expansion of the company, right? And the next point is business cycles. So see, during the period of inflation, the corporate management creates good reserves, for facing the crisis. And during deflation, higher rates of dividend are used as a tool for marketing the securities. So this is how they plan the dividend. And the next point is changes in government policies. Every now and then the policies will be changing. There will be a lot of restrictions, amendments, etc. in the Companies Act, right? Recently we have Companies Act 2013. So there are different changes. So based on that, the dividend policy will be decided. And the next point is trends of profit. The past trend of the company's profit should be thoroughly examined to find out the average earning position of the company, and that is when they can decide on how much dividend or what kind of dividend policy a company can adopt in this financial year. And the next factor which is influencing is taxation policy. Guys, you know what? Corporate taxes affect dividends directly and indirectly. Directly, such as they reduce the residual profits after tax available for shareholders, and indirectly, what happens is distribution of dividends beyond a certain limit is itself subject to tax. So it's very difficult for them to decide. Only after the taxation policy they can decide on the dividend policy. And the next factor is future requirements. If the company feels they should have or accumulate more reserves to face the uncertainties in future, and they would decide on the dividend policy based on the future requirements. And the last factor which is influencing the dividend policy is cash balance. Okay, so cash balance is the working capital of the company. You know that for day to day expenses of the company, working capital is very very much required. If they pay out all the profits as dividends, what will the company do to maintain the day to day expenses? So after calculating the cash balance and requirements, they decide on the dividend policy. So these are the factors influencing dividend policy. And the last topic of this chapter is bonus shares. An extra dividend to the shareholders in a joint stock company from surplus profit. Guys, dividend may be paid in the form of cash or shares. When it is paid in the form of shares, it is termed as bonus shares. It's very easy and simple to understand, and I have also discussed when I was discussing about types of dividend. Yes? And now let's discuss the advantages of issuing bonus shares. See, for the first advantage is maintenance of liquidity position. By issuing bonus shares, the company does not require paying any cash to the shareholders, and by this, the company can maintain its liquidity position. And that's the advantage of issuing bonus shares. And the second advantage is satisfaction of shareholders. And when the company issues bonus shares, what happens? The number of equity shares increases for the shareholders. And don't you think it's a very good advantage? Yes, and the next point is economical issue of capitalization. See, the bonus shares does not involve huge expenditure. Okay, it is very economical issue of capitalization, and that's why it's very useful for the company. And the next point is remedy for undercapitalization. When the company issues bonus shares, the rate of dividend per share will come down. And don't you think it's a remedy for undercapitalization? They don't have to pay interest, right? And the next advantage is it will enhance the prestige of the company, and the goodwill also be enhanced, okay, when the company issues bonus shares. And the next point is widening the share for market. Okay, a company which is interested in the wider ownership of its shares always can issue bonus shares. It's a very good advantage for the company. And the next advantage is finance for expansion. By issuing bonus shares, the expansion and modernization programs of a company can easily be financed. Okay, it's a very good advantage for a company. And the next point is increase marketability of shares. When the company issues bonus shares, the marketability of the shares will be increased, and now this would be an advantage for the shareholder. And the last advantage is increase in the income of shareholders. When there is extra share, they have extra capital or extra money, right? The dividend also what they receive will be extra, so it's an extra income to the shareholders. These are the advantages of issuing bonus shares. So this is the end of the chapter. Thank you for watching. Please like, comment, share it with your peer groups, and subscribe to our YouTube channel. And feedback is always welcome. Thank you.